This is my actual tax return. At first glance, it looks like I paid $638 of federal income tax. I actually paid $0. Look again. Hello everyone, my name is Zach and welcome to On Cash Flow, where I help you become a master of your own cash flow. Now let's get started. It appears that I had a $638 tax bill on $48,000 of income. I'm going to show you how that is actually a $0 federal income tax bill, but let's first calculate how I got to $638 on $48,000 of taxable income. Well, first off, $48,000 is already relatively low amount of income, and so you automatically are going to pay lower income tax on a lower income because of the progressive nature of the tax system. But besides that point, looking at the tax form, you can see that I had $48,075 of total income, and then I had $7,719 of adjustments to my income, which adjusted my taxable income down. And those adjustments consisted of my HSA, which was $7,300 for two people, and my self-employment tax. 50% of the self-employment tax that I paid is an adjustment to my income, which was $419. And that adds up to my $7,719 of adjustments to my income. Not only that, but you can also take the standard deduction, which I did, which was $25,900 for married filing joint. And then I also had a qualified business income deduction, or a QBI deduction, of $1,112, and that is for my YouTube business income. Take that total income, subtract out those adjustments, the standard deduction and the QBI, and it comes to $13,244 of taxable income. So not very much. However, if you were to calculate that out using the marginal tax bracket of 10%, which is the lowest marginal tax bracket, you would see that the tax bill should have been $1,300, around there. However, it was only actually $638. And the reason for this is that some of that taxable income was long-term capital gains and qualified dividends, which are taxed at a lower rate. In this case, they were actually taxed at 0% because of where my total income fell. It was under the certain amount, and therefore those long-term capital gains and qualified dividends were taxed at 0%. And that's why the tax bill appears to be $638 on $48,000 of income. And by the way, if you're interested in minimizing your federal income taxes, I have a complete guide to doing so, but more on that later. First, let me talk about how that $638, what appears to be my tax bill, actually became $0. And that is through the magic of tax credits. So I had two tax credits this year on my tax return. The first one is the foreign tax credit, and the second is the retirement savers credit. So my foreign tax credit was worth $238, and the reason why I got that tax credit is because I hold international index funds within my regular brokerage account. And when those international index funds pay taxes to foreign governments, they go ahead and pass that on to me as if I paid it because I was a partial owner of those companies. Then that tax that I paid is able to be taken as a tax credit on my US tax return. So that's why I got $238 of a foreign tax credit. And then the second one was the retirement savers credit. So I contributed to a Roth IRA this year because I had earned income from my YouTube business, just a small amount. Because of where my total income fell into the range of the savers tax credit, I was able to get a tax credit using the savers credit. That savers credit is non-refundable, which means it just wiped the remaining tax liability away. So it happened to be worth $400 because that's the maximum amount that is allowable to make my income tax zero. The $238 from the foreign tax credit and the $400 from the savers credit equals $638, and that effectively nets me out at a $0 federal income tax bill. Now, real quick, I do put a lot of research and effort into making these videos, so I would really appreciate that if you just took one quick second and hit the like button on that video. It really does help me out, and I would really appreciate that. Okay, but seriously, let's get back into it. There's another tax that I did pay that's on my federal tax return besides federal income taxes, which ended up being $0, and that is self-employment tax. So because I have a small business, my YouTube channel, I do pay self-employment taxes on the profit that I make from this YouTube channel. My self-employment tax ended up being $836. Not that bad, right? And that's just because the YouTube channel doesn't really make that much money, okay? If you're looking for a good side hustle, YouTube might not be the best side hustle for everyone. But besides that point, the way that self-employment tax is calculated is supposed to be 15.3% of your profit from your business. Now, it's actually 15.3% of 92.35% of your profit. So as you can see on my tax return, I show a $5,922 profit for my YouTube business, and the profit is then multiplied by 92.35% because that's the amount that's going to be taxable, and that is $5,468. And then you take that number, multiply it by the self-employment tax rate of 15.3%, and that's how we arrive at an $836 self-employment tax bill. And that self-employment tax is meant to cover Social Security and Medicare taxes. If you have a W-2, then on your statement, if you made that exact same amount, then you would pay actually half of that, 7.65%, because what it's supposed to be is supposed to be half paid by the employee and half paid by the employer. But if you are self-employed, you have your own business, then you pay both of those, which is 15.3%. Now this leads me to the big question here. I want to know from you in the comments below. What are your favorite ways for reducing your federal income tax bill? Are they similar to the ones that I've used this year on my tax return? Are they different? Do you have any other ways that you are able to reduce your federal income taxes? Please let me know in the comments below. I'm really curious to hear what you have to say. But now I want to touch a little bit more on when you become financially independent, it's going to be easy for you to pay very little in federal income taxes if you want to do that. And why wouldn't you want to do that, right? And there are many reasons for why that is. The first one is you're probably going to have a lower income. And just by having a lower income, because you might not have a full-time job, maybe not. But if you're financially independent, retired early, you might not have a full-time job, and therefore you might not have as much income, and therefore you're not going to be taxed as much because of the progressive nature of the marginal tax brackets. Secondly, if you have invested over the years into a regular taxable brokerage account, then you might also be getting some of your income in the form of qualified dividends and long-term capital gains, which are taxed at a different rate than regular income taxes. So they have their own special tax brackets, and there is a certain amount of that is actually taxed at 0%. And I think that amount is actually relatively generous. So you could get away with paying 0% on your long-term capital gains and qualified dividends like I did with some of my taxable income. And then you have the fact that once you are financially independent, you have the freedom to pursue what you want to do as far as work goes. And if you're starting a side hustle, as they call it, you might be starting a small business on the side. It's easier to not pay any federal income taxes with self-employment income than it is for W-2 income, because you have what's known as business deductions, right? You have expenses for running your small business, and that can offset some of the income that you make. And sometimes that can leave you with a very small amount of profit, and therefore you'll get taxed on a smaller amount than your total income. You'll get taxed on the profit instead. Whereas you don't have that advantage when you are a W-2 employee. You still have expenses as an employee, but you are not able to deduct those in most circumstances. And then of course, you still get to take the standard deduction once you become financially independent, and it's actually pretty generous if you're married filing jointly, half of that if you are single. And then you also have adjustments to income, which you can also take. As you know, I took the HSA adjustment to income because I put money into my HSA, and there are many other adjustments that might apply to your tax form. And lastly is the icing of the cake, and that is the tax credits, right? So there are many tax credits that you might be able to take advantage of even while you're financially independent that could wipe away your tax bill. Some of the biggest ones, of course, are the savers credit. If you have earned income, you can still contribute to retirement accounts. It might be the child tax credit. If you have a child under a certain age, then you might be able to take a child tax credit, which is pretty generous. And then also there's possibly the earned income tax credit. If you have a very low amount of earned income, you might be able to take that as well. All of those reasons combined is why once you become financially independent, it's going to be pretty easy for you to not pay any federal income taxes, or at least a very small amount. If you're ready to get serious about slashing your federal income tax bill, even right now, then you definitely need to check out my complete guide to reducing your federal income taxes. Okay, that video is going to pop up right on the screen right after I get off the screen. Thank you so much for watching this video. I'm Zach from uncashflow.com, and I hope to see you next time. Consisted of, that is then you would, do you have any unique, okay.